Welcome to Small Business University Online, powered by Small Business Expo, America's largest business trade show and conference for small business owners. Please be sure to check out our complete webinar schedule and all on-demand recordings from previous webinars on smallbusinessuniversity.online. All of our webinars are full of incredible information to help you grow your business. This webinar is being recorded and will be made available within 24 hours on smallbusinessuniversity.online. In order to ensure optimal sound and video quality during this presentation, please make sure you are logged in using the latest version of Google Chrome. If you encounter any technical issues during the webinar, we suggest that you log out and log back in to reset your system. And now, I'm very excited to introduce today's webinar. Please take it away.
Hello, how's everyone doing today? I'm not sure if you guys, or is this interactive or not, but my name is OJ Thomas. I'm with Total Pay Solution. I'm the CEO of the company. We handle credit card processing through APIs and all types of different situations. Today, I wanted to talk about how pricing works. There's different pricing out there in different models, and it's not one that fits all. So, having said that, let me go ahead and start with this so we can move through this as quick as possible. This is just if you have the handout, by the way, on the right hand side, there's a handout. If you'd like to print that out or follow along, you can do that with the handout. Every card transaction has three underlying costs per cost layer: provider, network fees, and interchange. Now, what are these real quick? Provider markup. So provider is basically us. We mark it up from the networks. So we're the processor, and we take the network fees, which are interchange plus, or network fees would be Visa, MasterCard, Amex, Discover, their fees that they take per transaction. Then interchange is what the actual cost is of that card. There's several different card types, several different interchange types. And so depending on the card type, it could be marked up for any reward program or anything like that. Different pricing models mostly change how costs are packaged and disclosed, not that underlying interchange itself. So basically, interchange paid to the credit card issuer bank varies by card type and acceptance. So every card is independent. Network fees paid to the card brand association, typically small amount, unavoidable, and that would be your Visa and MasterCard, like I just mentioned. Providing markup and processing, fax, revenue, and service fees with others. So this would be the processor, which is us, and a fax is another name for Square or PayPal, or it's also known as an aggregator, which we'll get into that next or down the line. Interchange, as we break it down to card types and reward levels, basically versus premium rewards, debit versus credit, how the payment is accepted, is it chipped, keyed, or online transaction, customer versus commercial B2B, card present and non-present. These are all factors on when you're doing an interchange plus. I'm not going to give you which price is best for you, but I will let you know that interchange is mainly with larger customers. I call it the Walmart deal because it's passing the hard cost on to you guys without marking it up for additional profit. It's a fraction of profit instead of several percentage points, I guess you can say. Remember, interchange is not your provider's rate. It is the underlying cost that passes the bundle into their pricing. Network fees paid to the credit card brands. So we're going to break them down one by one real quick. The network fees, assessment and network acceptance set by networks. may vary by card brand, and that would be Visa, MasterCard, Amex, Discover. You'll see these in your statements. You'll see Visa charges, stuff like that. You may not ever hear about this when you're being told about your pricing is because they're either being passed through to you or being bundled in a different way. But all these fees, no matter what, are always included, either bundled into to a flat rate or some other pricing, or broken out at cost. What to look for in a statement: are network fees showing a pass-through line item or bundled into your rate? Are brand fees, assessment, and network items clearly labeled? If bundled focus or total effect rate and total fixed fees. Let's see. The tab. I guess somebody's looking for the handout. I do not see the tab in order to receive the notes. And then I have another question. Are there any banks that offer tap to Android like Chase, tap to iPhone, where customers can tap to your phone and pay using a credit card? Banks aren't the issuer. We do those. That we are the processor. The bank, to be honest with you, does not have those tools as we would, because the banks aren't processing your transactions. It's a companies like ours, First Data, Payment Tech, PayPal, not PayPal, sorry, PaySafe, things like that run those transactions. So Chase Bank, they will overcharge you, and they may or may not have the hardware to offer you. But that's exactly what we do. We are the bank. We compete as a processor. We are the bank, but we work strictly with ACH, cash, and credit only for business to business. So good question. Okay. Provider markup when pricing model or provided differ most. It may include, and I'm sorry I'm rushing through this, but per transaction, percentage plus transaction, or a blended rate. Gateway platform fees, PCI programming, statement, support fees, other fees that may require, risk program, reserve holds, chargeback handling and cost. I could go on another whole webinar just about reserve holding and chargebacks. It's very important. Value added tools. What do we provide? POS, invoicing, reporting, payroll, integration, direct integration of different POS systems. We have our own internal system that we have that does the credit card processing for mobile, like I think Kevin asked about. So we do have that with Android and Apple iOS, Apple, iPad, whatever you want, iPhones. Common hidden costs, minimum monthly fees and statement fees, PCI fees, equipment lease or long-term POS contracts, gateway or tokenization fee for online payments. These all should be provided for you up front with a contract to sign. These aren't, if they come up and are not pointed out to you or you do not see them, then definitely that all that information should be given to you before signing any type of contract. Most pricing offer fit into one of these models: flat rate, which you guys are probably more familiar with nowadays, interchange plus, which I've been talking about, dual pricing, and tiered pricing. Also surcharge down here, but we're not going to really get into surcharge because surcharge takes an additional add-on system that they just brought out. So if you're out there doing surcharge right now and not have checked in with your current processor provider to make sure that they've sent in the documentation to verify your ability to accept that, you could get yourself into some, not legal troubles, but some fines or something back from the issuing card, Visa, MasterCard, Amex, and Discover. So you're used to maybe seeing, you'll see this on Square or something like this, a bundled rate. Giving an example, 2.6 and 10 cents per transaction. Under underlying interchange fees, but your billing rate stays the same. So basically what that is saying is that the fees that we discuss, interchange, assessment fees, are bundled into this rate, this 2.6 and 10 cents. All fees are in there. And that's how the they make their money, or in our industry makes money, is how we price. So, for an example, for just give you an example, why the interchange is so much better than a blended rate. Let's just say you're doing a debit card, which interchange cost is 0.5%. So interchange cost is 0.5% and 15 cents a transaction. At 2.6, they just made 1.4. Square just made 1.4% on profit on that one transaction, to where as interchange or big business type, you would only be charged maybe 0.5%, 0.50, 0.05% profit instead of 1.40% that Square would do. So that's the difference. We can also do flat rates, but once again, it is more profitable for us, and I won't sugarcoat that. I want to make sure that this is a legitimate, webinar about pricing. Pro, simple and predictable billing, fast. Let's see what time it is. Fast onboarding, minimal statements, complexity, best fit new small merchants. Team, prioritize simplicity over optimization. Watch out. You may overpay on low-cost transaction, regular or perfectly regulatory or debit transactions, and pay a lot more than you necessarily have to. Least flexibility in negotiation as volume grows. Standard risk control can mean tighter holds for some profiles. So that means basically a couple of these are mainly based on Square or aggregators, but it does apply to us if you are on that system. Standard risk control is because the risk of being underpriced or something like that. How it works: interchange plus pass-through, what I've been speaking about a little bit. Provide markup, 20 basis points and 10 cents. What is requested? A complete fee schedule. Now, this statement is a much more complex than a regular statement because it breaks out your interchange. It breaks it out by category. And that's why when sometimes somebody asks you for a statement, it's because they need to see the type of card types you're doing to do a more depth analysis, I guess you can call it. Simple statement based on your volume and mix, markup expressed as percentage and transaction, not single headline rates. Why businesses choose interchange plus. Transparent separation of pass-through cost versus provider margin. Easy to audit statements and negotiate markup. And that's exactly why somebody will come to you and say it's easier for us to work with these statements because we know exactly who is getting what, I guess you can call it in simple terms. Often better economic as volume grows and mix is stable. Watch out, statements can look complex. More lines, confirm all fixed fees, PCI gateway platform and minimums. Ask how downgrades, non-qual categories are handled, especially for B2B businesses. I'm not sure if there's any B2B out here, but there is a different interchange for business to business with level 3 programming. It's something that is not widely promoted or shown out there, but if you're a B2B business, there is a better interchange for you. So you need to make sure whoever you're with they have you set up on the right interchange, and if you have level 3 processing, you are set up, but there are new regulations that you might want to look into. 3-tier. This has been around. This is the original tier pricing. You have a qual, mid, and non. How it works. Basically, you have your 3-tier, qual, mid, and non. Now, this is a bait and switch kind of deal. What they only tell you, most agents will tell you the qual rate. Okay, we're going to give you 1.59 and 10 and 25 cents a transaction. What they're not going to tell you usually is you have a mid qual of 3.10 and a non-qual of 3.99. It's not something that they may bring up. So you always need to make sure when they offer you just a qual rate, a one rate. Hey, what's my rate for any mid downgrade quals? If you have Square, you may know that there's a different rate for swipe than e-commerce or Moto. It jumps pretty differently, and that's because of how it qualifies within the interchange categories. Again, everything that we work with is based off interchange. Also, the interchange is printable. It's not something that's hidden that you don't know about. You can go on Google and upload interchange categories for 2026, and you'll see it pop up at MasterCard and Visa. Those are our costs. It's like looking under the hood. You see our costs, and everyone, no matter how big or small, you may be who processes you may be working with, we all work off the same system, the same cost, I guess you can say. Why to be curious? Harder to audit, qualified differs by provider. Now, what that means is that we, as a provider, control what falls into the qual, mid, and non. I'm not going to get too deep into it, but we decide within our systems how we want to qualify those cards. Now, having said that, we have to make sure we qualify them higher than interchange. It's a lot of math, but we control that. So a lot of providers will only put limited cards in qualified. Mainly those cards that really qualify for that great rate that they're offering you are cards that are debit cards or cards with no value. Value means reward cards, any kind of card that brings value to it. And as you probably know, there's not that many cards, even debit cards have value to them now. So very few cards will qualify in that category. But they don't tell you that until you find out 3 months later. Why am I not getting that category? It's because of the cards you're taking. It's always based on the card type. Written different for each tier. Example of which transactions types fall into each tier, and an effective rate established based on your first to 3 months volume. I'm not sure if you guys know what an effective rate is or how to do the math, but I will talk more about that as we move along. Cash versus credit. Now, you guys may have seen this out nowadays. It's been around about maybe 5 years, but now it's really caught on. It was called cash discount at one time. Had to go through some legalese, and now it's called dual pricing, to where you can push the 100% of the fees to the customer. Okay. It's either a cash price or a credit price. Our systems, and the system should show you if it's legitimate. If it's a legitimate setup, your cash price on your terminal, it has to have a screen that shows your cash price and your credit card price. There also has to be a signage showing that you're charging a marking up your credit card price. There's different pricing depending on how you want to set it up. There's really 3 different pricings. If you're doing Moto or e-commerce, it's going to be 4%. If you're doing swipe, 3.75%, and then if you're doing small swipes or anything, 3.25, and that's based on, again, card type. Why higher than regular do we push it to the customers? Because of interchange. Once again, we don't know what card you're going to take, so we have to always cover our biggest cost. And again, our biggest cost is Amex interchange. So that's why it jumps up to make sure that even Amex is covered, Visa, MasterCard, because a card can go from 0.5% up to almost 4%. 3.75, I think, is the highest for Amex card interchange. So we always have to make sure those fees are covered, and that's why you'll see it a lot higher to the customer. If they do cash, the system will just run it as cash, and it'll report it to the portal. Most systems nowadays have back office portals like ourselves. We can monitor this and manage it accordingly. Customers facing merchants who want predictability, cost recovery. Best when the POS can clearly display cash and credit as our credit card pricing, as I mentioned. Watch out for must be configured as true dual pricing cash discount, not an accidental surcharge. Extremely important. Visa is now, with the new rules that have come out over the past 6 months, especially with surcharge, they are now, because they've seen a lot of businesses out there using, Square with surcharging them, their customers. Square is not authorized or allowed to do that. So because they don't have the system built within there to actually do it correctly for interchange purposes. So what has happened is that they've now made it even more strict, and so they have there's secret shoppers that go out for Visa all year round, and they'll find them and charge and fine them until this gets under control. And we were in a big conference talking about this, but they are going forward this year, and I don't know for how long, about surcharge, because it has become a problem, and it needs to get under control. Clear disclosure required: signed menu, self checkout receipts. The price would be on the receipt. It would show the cost, the markup, the total. It also shows you that in the back office portal with a system. It'll break it out individually for tax purposes, so to make sure you can write that fee off, since you're not collecting that. We are. Rules vary by state and by channel, in-store or online. Confirm support. Basically saying, find whoever you're working with, make sure they know the rules of each state, and all our systems are compatible with every state, so we don't need to worry there. Oops. I didn't realize they put the surcharge in here. Credit only. Okay, so basically the way surcharge is supposed to work going forward. Alicia, I will answer your question in a moment. Post price, basically the way it works, you have your post price, surcharge, credit only. So you have credit. The cost on that is 3 basis points. No, I'm sorry, 3 basis points, 3%. The max you can surcharge a customer is 3%. So basically it works. We charge the merchant. The merchant charges the customer. It breaks even to zero. Back to zero, no cost. But with the new Visa MasterCard rules, you always have to have a second option of paying with a credit card or with a surcharge. Now, it's not cash, but it does recognize your terminals now need to be able to recognize if it's a credit only or debit only and I don't want to get too much in the lingo, but non-PIN number. So it doesn't need a PIN number. Your terminal should recognize that it's a debit card or a check card, and it should not charge that 3% to that customer. That it will charge. Well, it'll pass through that interchange cost to the merchant. So basically, the merchant pays the interchange for the debit if it is a debit card. If not, the surcharge covers it as a credit card. And your terminal is supposed to recognize that, and that's where Square falls short. It does not understand those differences. It does not have those tools. So that's why they were trying to figure out why they're doing that. But anyway, I don't want to get too deep into that. Merchant has a card-heavy volume who wants to offset expense costs. Best when a POS can automatically exclude debit, prepaid, and print compliant receipts. Again, the receipts have to be compliant. Watch out, register, notify Visa and MasterCard. So anytime you set up, anytime one of our merchants needs to be set up with one of these, we have to register them with a Visa and MasterCard on the back end. You don't even know it's happening. But if you're not registered, you could be fined thousands of dollars. I didn't put it in here, but it can get pretty freaking high, all the way down to closure if they catch you several times. Via your acquirer process, often 30 days before you go live. Now, they say that, but it's also impossible. So, as long as we catch it before the 30-day, you're ready to go, or processing within 30 days of processing with us, you're fine. Cannot surcharge debit. CAP must comply, often below 4% and not above or actual cost. That's a little way of saying you can't charge debit or prepaid cards as a surcharge. State law and card brand rules vary, confirm disclosure signs and receipt requirements. Again, this is all built. This should be built into all your systems. That if you are using this, it should already be built into your systems. Very important. Let's see. Let me see. Ellis, let's see. Webinar, please. A question. Could I change it to a different bank when I have opened a business merchant account? I have used the bank, but I'm not happy with their service. You can always change your bank account. Your bank, that's why you want a processor, not a bank, because the processor is not your bank. It processes those transactions and drops them into your bank account. All you need to do is reach out to your current credit card processor, tell them you want to do a bank change. They'll send you a bank form. With that, they'll ask for your signature, and usually, if you don't already have it, they'll ask for a copy of a voided, or they will ask for a copy of a new voided check, and probably a copy of your driver's license to verify who you make sure. And then, depending on what process you went, it could take 24 to 48 hours to switch that bank account. But then it would automatically happen, and you would see your batches going into that new bank account. And once you would see that, you can cancel. Sorry about that. Let me off my office phone. I'm offline. Sorry about that. Okay. Good question. Different effective rates usually come from different transactions, not just provider markup. We're going to talk about effective rates real quick. Effective rate is the overall rate that you're being charged. That's the bottom line. You see, it doesn't matter at the end of the day what somebody's offering you. That sales guys are going to be salespeople. Unfortunately, sometimes, we try to hold to the best of our ability. But definitely, with new business, you're in a different world, and you get unscrupulous sales agents sometimes that will tell you anything to get the deal, because these guys are with different types of companies. Personally, our company does not go after new business. We usually wait till about 3 years just to make sure you'll be able to make it till we go, because we want to see an actual statement provider, and we're not trying, because the way we compete, we don't believe in flat rates and things like that. But that's our own opinion. But you need to know what your actual overall cost is to be able to make this happen. So if you look right here, I just uplifted effective rate. So basically, you need to take acceptance method, what type it was. It'll tell you within the statement. Card mix, average ticket, industry risk, chargeback, settlement behavior, data level system, or cross-border international cards or anything like that. That's all in your or built into your statement. What you want to do to find what your actual true rate is to go and get your total fees, divide that into your total card sales, and that will tell you what we call the effective rate. And that's really more for interchange category or 3-tier. If you're on a flat rate, it's pretty much what your rate is. You're just being overcharged. But like I said, it's simple reading. But if you're on any kind of tiered program, interchange program, even surcharge, because even surcharge takes in transactions, so you're not you're still doing debit, so it's not going to be high, but you still have an effective rate. Dual pricing would be only effective rate for your monthly cost, because we would pass all those fees and costs to the customer except for your monthly hard cost. Thank you, very clear. I appreciate it. No problem. Okay, so this is getting a little bit behind the scenes. Both route transactions through networks. Difference are account structures, underwriting, control, and risk management. So you'll see here, now we're breaking out an aggregator. What is an aggregator? An aggregator is PayPal. Basically PayPal, Square, Stripe, these guys that they don't do any background on your business. Some of you may have these, you sign up, and now you have a credit card processing. It's great for beginners because you don't have much overhead. They majority of the time they may give you a little swipe. I don't know if you may purchase something from them, and it's all great as you start off. But as you start growing, you start realizing, hey, I'm losing some serious money in using the Square system or Stripe. That's because their fees their rates are much higher than industry rates, and around $5,000 is the break even. And what do I mean by break even? Why do people use Square? Because it doesn't have a monthly cost. Our monthly cost, once you hit the $5,000 mark on a regular basis, basically zeroes you out. And now traditional account processing is more cost effective than having higher rates, because the monthly fees really our hard cost monthly fees, they're usually not higher than $15 a month, $12, $15. And when you're on Square doing less than that, though that is more expensive usually than what you make, than what they are charging if you're only doing less than 5,000, because those are random. You're not doing stuff every day. And so that falls under that. Account structure, sub merchant under the master account. What does that mean? That means you don't own your merchant account, and basically you don't own your business, because what happens is Square, since Square is the big one, holds that MID with the processor. So basically, let's just say Chase Bank. I don't know who does the processing for them, but it is probably one of the larger like maybe I would have to guess First Data that's the big elephant in the 800-pound elephant. First Data would probably process their systems. So they have one MID. Can you imagine this? They have one MID, one business, just Square, but then they have 10,000 TIDs, and you're one of those 10,000 TIDs down here. What is a TID? Terminal identification number. So you don't exist in the world that we live in. You exist as only a terminal. So your business is not recognized. If Square decides to shut you down, or you have any issues with them, with their ability to, if they believe there's a fraud or something, you have no recourse. If they shut you down or hold you money, that's it. You can't go to the processor and say, I want to dispute. You can't, because you don't own the processing. Difference, merchant account processor, dedicated merchant account under acquiring bank and relationship. So not only are you with us, but you're also with our acquiring bank. And we have different banks we acquire with. We work with Wells Fargo. We work with Wood Forest Bank. We work with Bank of America. It's depending on the type of business that you are, high risk, low risk. Again, you never see any of this because the contracts all look the same, because they're our contracts with a bank approval. Of course, the logo saying that we are acquirer. We are with this bank. So that gives you direct access not only to to your own merchant account or merchant ID. It gives you access to the relationship bank or the processor ourselves, or a direct interchange. So you're able to get the help you need for chargebacks or anything to get for your own purposes, without relying on a third party, which they're not looking out for you like a process. Because at the end of the day, you lose money on chargebacks or fraud, we lose money. So it trickles all the way down. With Square, they'll just shut you down. It's just done. They're not going to even bother with it. I'm beating a dead horse. Onboarding, because I see it too often. Onboarding speed, fast setup, standard onboarding. That's very fast. More underwriting here. Yes, we do underwriting. It's slow, but more tailored, because it's tailored to your business. Underwriting, because we need to make sure because we are opening up a valid account, credit card account, bank account for you within one of our banks to process your credit cards through. So it has to go through an underwriting process, which does take time, anywhere from 3 to 4. We can have you up and ready to go within 24 hours, depending on what underwriter says. And it also depends on what type of business you are. Higher risk, Moto, internet, CBD, those are high risk accounts. They will take longer than regular brick and mortar accounts. Open flat rate standard. So they have one standard flat rate, and you don't have a choice. Often interchange plus, customize, more negotiable. So we can negotiate what's best for your business, and where they do one size fits all. Centralized risk control. Hold can be more standard. They will hold it. Risk profile tailored. Reserve hold depending on underwriter and history. Basically, they will hold money for no reason. Our risk department will reach out to see what's going on. If there's some kind of risk issue, we need to put a hold on it, or they're willing to, or put a reserve saying, okay. And this usually happens with the high risk merchants. But again, it's more since Square has no idea what type of business you are, it's more to happen with them as with us, because we already know the history, we know everything. And as long as it was truthful and honest, there's no issue. Control and flexibility, simple tools, less customization. With Square, you get what you get. It works. It's not a bad system. I like it. But that does have some limitations, more configurations, gateway, reporting, routing, multiple MIDs. You have multiple MIDs. We can even have one system if you have multiple locations. You can have multiple MIDs for each location. You can do, if you have different businesses, we can set up the different businesses within a one system setup, POS system. Best fit. New, small, or team, prioritizing simplicity. Scale merchants needing control, optimization, or complex flows. So basically, if you're looking to scale your business and build a business, then you want to. It's good to maybe start here, but if you really want to make it, you need to eventually get off and move into a real processing solution. Let's see. I have a couple of questions on the 5K. 5K sales or $5 process? Did you mean 5K per a day or a week? I mean 5,000 a month. It needs to be. It can't be one. It needs to be like 1,000 a month. So if you're less than 5,000 a month in sales, it's better to deal with Square than to a traditional correct. If you're not doing 5,000 a month in credit card processing steadily, and knowing that you're growing, stay with Square, because the monthly fees are more expensive than what you're being charged. It's going to be $12.15, and you're going to be charged less than that because you're not doing any. In our world, there's that's no transactions. All right, all good questions. I like it. Simple decision lens, volume and complexity. Aggregator, PayFac, we call PayFac, but that's actually Square. Simple operation, fast setup, standard pricing. Traditional account, higher volume, benefits from negotiation price. Traditional accounts, complex flows, scales often require dedicated merchant account. It depends. If complexity increase, multiple location integration will revisit your setup. So basically, as you grow, you may grow out of your ability, especially if you're starting to add locations. Hopefully, you've moved away from this before you start adding locations, because you lost a lot of the money that you could have used to purchase that second location. Questions to ask yourself: is your volume stable and growing? Back to your questions. If it's 5,000 1 month and then there's nothing, and then another 5,000 in 3 months, 4,000, 5,000, or 3,000, Square is where you're going to be at, because those months that you aren't processing, you're going to be hit with a monthly cost for not doing business. And so in our world, we do this to make money, and so you would more than likely have a minimum of at least $25 a month if you don't do any processing with a processor, because it does cost us money to have an account open. Do you need customer report multiple locations or integrations? How sensitive is your business to funding delays or holds? Do you need specialized payment types, B2B, reoccurring cross-border? Bottom line, pick the model that fits your operation and risk tolerance, and optimize pricing. So basically what it fits, if you're more of a high risk account and you're starting to do real big business, you might want to rethink about where you're at, because you're going to be put on More money you make, the more what Square is afraid of is big business. They don't want somebody that can do a chargeback and take them out of business. That's why they look for small businesses. That's why they want small business, because the transaction and the risk is low. When you start doing 30, 40, 50, $60,000 a month and you're using them, they're going to be all over you, because now you become a risk for higher chargeback, and that affects them directly. So the more money you make, the more they're going to be looking at you. The lower you make, you're under the radar, that you're good to go. When this was originally built, and I'll give you just a little bit of history before I move to the next one, a little bit of history on that. When this aggregator system was built, started with PayPal, and it was meant to do, little mom and pops outside, back before COVID, there was training, people outside doing exercise and things like that. And, we would see that. And that's what it was meant to do, was to do a small mom and pop shops that just didn't need the full-blown system or full-blown everything that we had, and bury them in monthly fees. And that's how Square and PayPal came to be as they are. Now, their marketing is genius, which has made them blown up, because it makes it seem that they're giving out the best deal, but actually they're making so much money that it's pretty ridiculous. But people like it because it's simple, and you can't argue with simple, I guess. Which price model is offered? Flat rate, interchange plus tiered, dual pricing, surcharge. That's what we can offer. We can offer any one of those. Which fees are passed through or provided markup. So you need to offer evaluation checklist. If you look following the heart, you can now start checking off statements. This is the checklist you would want to use. What fixed monthly fees? PCI Gateway Platform Statement. Funding, time, operation, and cost, standard or expedited. Chargeback fees and support process. Dispute response timelines. We fight for your chargebacks. I don't know what Square does with chargebacks, to be honest with you. When you have a chargeback, we are on your side 100%, and we fight with our chargeback department to make sure that at the very, we do everything we can to get your money. Refund policy and whether regional fees or return on refunds. Contract length, early termination fees, and equipment comments. What triggers reserves and holds, and how funds are released. It's a good checklist to ask. Statement review, quick method. Again, effective rate, total fees divided by total sales equals what you're actually paying. Thanks for making this decision on nothing. I guess I'm lost the track. Then list all fixed monthly fees. Identify any missed or non-equal. There's different ways to break it out, but the most easiest way is just total, grand total. At the bottom or at the very top, it gives you your total card sales, and also it should give you your total card fees. Divide it into, and it'll give you a rate. Next steps, put your most recent statement, the last 30 days, calculate effective rate, like I mentioned. Let all fixed monthly fees and all unusual line items. Use a checklist, line 16, page 5, to complete the offer, to see where you stand, to compare offers, what you're getting, what offers out there that you want to go look at. That will do as far as the slides. I'm open for any additional questions. You do have our contact here, sales@totalpayllc.com, our website. If you would like to send us any, you'd like for us to do any kind of, analyzing your statements for you and just see where you're at and see if it's a good fit or not, and the type of systems, you'll feel free to email us your cell, or you can contact us at sales@totalpayllc.com and send us a statement, or you can email us there and say you want some more follow-up. You can even give us a call at 832-598-1917, 832-598-1917. Nate, Square does nothing. That is true. I don't. That is definitely. I'm guessing on your. You've had a run-in with them, yeah, and they don't. Nate, can you share where you found the handout, please? Okay, I'm trying to go back up, see if I missed anything. I don't think I did. Again, any questions? Feel free. If not, Leah, we are good to. I don't want to keep anyone if they don't need to.
Thank you so much for that informative presentation. We really enjoyed it. As a reminder, this webinar was recorded and will be available on demand within 24 hours on smallbusinessuniversity.online. Please remember to frequently check out our webinar schedule on smallbusinessuniversity.online for other great weekly business building webinars. Thank you all for joining us and have a great rest of your day.